and I think we've gone through a bunch of different things here. Could you just walk through, yeah, more specifically to just high level, the actual how it works from the tax perspective? Because I know that's one of the biggest benefits that obviously gets advisors, both on my side and the tax side excited. So maybe walk through what it looks like for a C corporation and what this transaction looks like from an S corporation perspective.
Perfect. So there's three key significant tax benefits of an ESOP, which is one reason why they're gaining so much traction. The first is there's a concept called, and I'll just give you the acronym on the tax code section, it's called the 1042. So those that have ever invested in real estate that understand 1031 real estate exchanges, or in the world of insurance, 1035, which allows you to swap from one cash value life insurance policy to another and roll your investment and your capital back in to the new purchase, you can avoid paying taxes on that rollover. ESOPs have favorable treatment that owners that sell their stock and do so at the time of the stock transaction as a C corporate sale and sell at least 30% of the stock to the ESOP can, for that portion of proceeds, elect the 1042. So if your company is worth, for simplicity, $20 million, and you're in a state like California or New York or New Jersey, where you've got close to 35 to 37% overall state and federal tax rates on capital gain, then in those states on $20 million, if you just simply say it's 40%, you'd have $8 million in taxes that you'd have to pay between state and federal, which is relatively significant. And so if you did it as a C Corp and you sold the 100% of the company, as an example, you could elect the 1042. You would reinvest a portion of the proceeds that would qualify into what they call qualifying investments, which are public company stocks, bonds, or debt instruments that fulfill the IRS requirements, and you're able to postpone paying state and federal capital gains tax. If you hold those replacement assets till death, your family inherits them, gets what they call a step up in basis, the same as the 1031 real estate exchange. They can sell then those assets out at that point in time, and they pay not a penny of capital gains, state and federal tax. So that's very attractive, and one of the reasons why in those states, when owners are looking at apples to apples comparisons financially of selling to a strategic or private equity or selling to an ESOP, if they get the same amount of money in both scenarios, but in one they pay no capital gains tax, it's pretty favorable. So that's the personal tax benefit. If you do it as an S Corp, you're subject to paying capital gains tax. And that's where a good advisor like you yourself, Carl, come into play, because working with advisors, most of our clients that do that in places like Florida, Texas, Tennessee, usually states that have no state or very low state income taxes, they say, you know what, I don't mind paying the federal rate, but I want to be able to manage when I'm going to pay it. Our clients elect an installment basis. They pay it as they receive principal over time. And that gives them time to do a tremendous amount of planning, from investment planning to create some potential offsetting losses to help minimize it, to charitable planning to help minimize the capital gain. So that's the nature of the front end for the selling shareholders. And that's, obviously pretty significant. When you get into the corporate benefits, this is where the dynamics between the C Corp, which is good for the selling shareholder because you can elect the 1042, but you ultimately want an ESOP company to be an S Corp. And this is the most attractive operating structure. And it's the only legal way in America you can be a for-profit company and be tax-free. 100% ESOP-owned S Corp is a tax-exempt organization. It's still a for-profit. So don't kid yourself. We're not converting from a for-profit to a not-for-profit company. It's a for-profit company that is exempt from paying any form of state and federal taxes. The benefit of doing that is pretty simple. Imagine now your company, Carl, and you're no longer subjected on all your profits of paying a dime of income taxes. One, it creates more cash flow. And when you go back and think about how we buy the company, it's a leverage buyout. We're now simply diverting the income taxes that the owners previously had to pay, most likely on their K-1 distributions at a much higher tax rate. And we're diverting that over to now turn around, since the company is tax-free, to turn around and pay off the debt. So the simple way I always explain it to every business owner is, let's just assume your company's worth $20 million and you're generating approximately $4 million a year taxable income. To make it simple. At ordinary income tax rates in your state, you're paying about 50% marginal taxes. So on $4 million, you're paying $2 million in tax, and that leaves the company with about $2 million of free cash flow, some of which you're distributing out for planes, trains, automobiles, vacations, fun, personal investments, real estate, things like that. The byproduct, though, is in an ESOP, we're going to take that 2 million of tax savings and we're going to redirect that to pay off the $20 million in debt. So we're taking the 2 million to pay off the bank debt and the seller notes. And then hopefully over the next few years, while we're doing that, the company grows from 2 million of net profit or 4 million net profit to 4.5 to 5 to 5.5, because your employees start thinking more like owners, since they now directly get benefits tied to the stock they get allocated. So you change the cultural mindset of your employees to start thinking like focusing more on customer service, profitability, margin expansion, all the things that will drive increased profitability for the company. So over the next typically 8 to 10 years, all the debt gets paid off, and it all gets paid off out of the tax savings, being a tax-free organization moving forward. Now, let's get to the last attribute, and that is, if you're an S Corp today, and you want to do the 1042, and you have to what they call revoke your S and convert it to a C, so you can do the 1042. Under the IRS's guidelines, when you do that revocation of an S to convert back to a C, you have to stay as a C Corp for 5 years. So for that 5-year period, you're paying corporate income taxes. So the key is during that 5-year period of time while you're paying corporate income taxes, the ESOP has additional tax benefits, meaning that the payments that you're actually making to the bank in the way that we structure them become deductible. And so we're actually getting additional deductions as a C Corp that you didn't have previously. And so we're not going to eliminate the corporate taxes that have to be paid during that 5-year period of time. But if normally you're paying 2 million in ordinary income taxes as a K1 shareholder, and now you get the 4 million of profit on the corporate balance sheet, we're actually going to reduce the profit to the company because of that debt payment we're making of the 2 million a year to the bank and the interest on your note. The byproduct is now you're not paying taxes on 4 million. The corporation is going to pay taxes in an example on 2. So at 21% federal rates plus state, you're at 25%. You've dropped 2 million in tax responsibility to 500,000 at the corporate level, which still leaves you $1.5 million more free cash flow you didn't have before. So that's the benefit during that 5-year period of time, which is attractive when we're doing either partial sales, because partial sales aren't 100% tax free. So that methodology I just passed on works in that scenario. Or when you're doing a conversion from an S or revocation to an S to a C to do the 1042, and we have to deal with corporate taxes, we minimize those taxes through the way the ESOP works.